I don't use trend lines in the usual way that other people use them, but I still think they are brilliant and can build a very solid foundation to your strategy. So in this video, I'm going to show you how trend lines work, how I personally use them inside of a 3-step strategy that you can start using today to ultimately help you win as a trader. A trend line is an area in a market where the market has retested multiple times. So it's basically a ascending or descending price level that is supposed to determine the trend. This is an ascending trend line because the market's going up. The idea here is that the market creates 1 tap, 2 tap, and then any tap after that, we expect the trend line to continue trading higher. In the case of a descending trend line, it is just the opposite. The trend line is drawn above price, and after 2 taps of a trend line, traders will then look towards the following taps for their trading opportunities. There are 2 ways that people traditionally trade trend lines. There is the retest and the break retest. So a retest is simply after the 2nd tap. Any further taps of the trend line, traders will look to buy. They expect the market to react from the trend line again and continue moving to the upside in the case of a bullish trend line, or to the downside in the case of a bearish trend line. Now, in a break retest, this is where the market fails to hold upon its retest. So in this example just here, instead of retesting, there is a break, which looks like this. This break is then, in theory, followed by a retest of the trend line, and sellers will step in inside of this area to bring the market down, expecting now that the trend line is broken, the market structure has broken. Now, there is a big problem with these 2 ways of trading. Let me explain. So here is a trend line in the wild. We have the 1st tap and the 2nd tap. After that, the standard way to trade trend lines is to sell the retest because we understand this is a descending trend line. It's moving down. The idea is to continue selling, expecting this trend line to react. And the other way to trade it is if the trend line breaks, traders will then look to buy the retest because they see this trend line break as a change in the market trend. Now, here's where the problem comes in. A trend line does not actually determine the trend direction of the market. See, what we should always be looking at as traders is the highs and the lows that the actual market price prints. If we take a look at this market, we can see we are clearly moving in a downtrend. We can also pull this previous piece of price action in as well. And we see that we have a low, and then we have a high, and then we have a lower low, and then we have a lower high, and then the market breaks down again into a new lower low. And at this point, we just need to validate a new lower high. So a high somewhere lower than this one. And that will actually just continue the market moving in its downtrend. Regardless of the fact that the trend line can break, the market still stays in a downtrend, okay? So if we map that structure on with a line here, our trend actually looks like this right now. It is a downtrend. The market is moving lower. This high is going to be a significant point to consider, because if the market pushes over that high, we will actually see a change in the high-low structure of this market. So it's this area here that would validate a change in the trend. And that would mean it would warrant buying. Meaning if the market was to pull back from that level, then we could look to buy because that would confirm a change in the trend structure and a change in the market direction. Now, the problem here then is, of course, if traders are expecting this market to move lower from here, realistically, it can still move higher before it moves lower. At the end of the day, if you think about what a trend line is, it's just a line that you've drawn on the chart, okay? It doesn't really factor the high-low structure of the market. Now, when we're looking at the real price highs and lows, we have the most clear image as to what the market's actually doing. When we're drawing lines, connecting dots, that's not going to give us such a clear story. So if you're a seller selling here, you can easily be stopped out if your stop loss is somewhere above the high before the market continues moving in the downward direction, because unless this high breaks, as we've just said, the market remains bearish. So it can go bearish from up here, it can go bearish anywhere underneath this high, and it would still be a sell trade opportunity, okay? The other problem is if traders are seeing this as the trend and they see a break as a change in the trend, they may end up buying a retest of this trend line, expecting the market to go higher, when realistically, as we now know, the market is still bearish under this high here. okay? So even if we get a trendline break, and even if the market traded all the way up to this point, it still remains bearish because the significant lower high is still intact. It has to break above the previous structural point in order to validate a change in the trend. It must do this, otherwise this is still a bearish market, and buying into this market is just not going to work. So this is going to lead us on to the next point, which is trend lines acting as somewhat of an inducement. So we have two forms of sellers here, or two forms of traders, should we say. First is the sell trader, who is going to be selling the trend line. General retail education suggests put your stop loss above the high of the trend line and put your target down into new lows. So this is going to be trade number one. Now, the other kind of trader, who is a breakout trader, is going to be looking for a break above, and then they will be looking to buy somewhere in this region to then take the market higher, seeing this as a change in the trend direction. So we have trader number one, a sell trader, getting in on the trend line retest, and we will have trader number two, the buy trader, looking to buy once the market breaks above this high and then retests the trend line. These are the positions of the standard trendline traders, okay? Now let's take a look at what happens in the price action. You see that we get a push up, which would stop out the sell trader. And this is also going to induce buyers into the market because sellers now see, okay, the trend line broke. It closed above, so we would be expecting to see a continuation higher from here, given that the trend line has broken in our favor. So then, as you see, trendline buyers who have now seen this as a break and retest opportunity are going to be getting stopped out as well, because what's actually happened is we've had a false break here, which looks like it's breaking out. This stops out sellers, and then it stops out the buyers as well. So if you're focused on trading trend lines in this standard fashion, you're going to run into some problems there because you're not moving with the real structure. As we've said, anywhere underneath this high remains valid for shorts, and we should not look to buy if the market moves above. And because we know that trend lines are not such a great thing to use for entries, because of course the market could come anywhere into this region before selling off, we would instead opt to use something that I call supply and demand. Now, this is a very common concept. Basically, what we are looking for is areas where the price has collected orders before moving away. So a supply zone looks like this candle just here. Okay, this one, let me just mark it for you. This candle here, this is a supply zone. This is a consolidation before a large downward moving price. And it's actually the zone that created the break-in structure. So there are two areas here of supply before this large down move. We have this one at the top, which is the last candle before the initial impulse. And then we have this second one. So it's this candle here and this candle here. What these indicate is an area that sellers have seen as a premium price to sell from, okay? So essentially, a supply is just a premium price. Now, if you are a seller, you want to get the best possible price, a high price to sell your assets, right? If you're short selling a market, you want to get a high price because you have better odds of making a profit on the way down. And if you are closing a buy position, you want a high price because the more you can sell your contracts for, the better. So there are two supply zones here, both of which are essentially just premium price areas. The reason they have significance is because, as we saw previous consolidation, the follow through of a large bearish downward move tells us that there is significant aggressive selling taking place inside these supply areas, okay? So if we return to this, we understand this premium price is likely to create a second reaction as new sellers step in, or the same sellers add positions with the understanding that this is a premium price to do so. So rather than selling the trend line, and rather than buying the trend line break and retest, we could instead just eliminate the trend line altogether, realistically, to get a clear picture of what's going on. And we can take a look at just the significant structure paired with supply and demand. Now, if we look at this significant structure, we've got our high, we have our lower high, and then we have our lower lows printed in this market, proving to us that this is a bearish market. And then we can use supply zones to sell from when the market returns to them. Now, the reason that we use trend lines, and the reason they are still useful to a degree, is not because we are going to trade from them, but because plotting them on charts allows us to see this kind of inducement, the areas where buyers and sellers are going to be trapped into trend line trades, and that's usually where our opportunities are going to present themselves. So if you are to draw on trend lines as you usually would, instead of looking at them for your selling or your break retest buying opportunities, you want to look for areas of supply and demand and consider the high-low price structure, and then you will generally use them to identify good areas for buying and for selling to take place. And one of those, in this instance, is going to be this supply zone just above the trend line. So realistically, we now use trend lines to identify inducement areas and areas where buyers will be drawn into markets and sellers will be drawn into markets. These are generally the areas where there are going to be enough orders for us to find a good supply zone and then sell into the market and follow price down. To show you how we could select between these two zones here, first of all, the top zone I'm generally going to be less interested in because this zone here did not lead to a break of structure. If we look at a supply zone like this one, which has created a break in the trend by pushing past the previous low, that is a strong supply zone because it tells us the selling that has entered the market at that given level is strong. So the selling is way more aggressive from this point than it is from this point. Now, sometimes it's going to be a little bit trickier than that for you to find an opportunity in a trade like this. So what you can actually do is use what we call a confirmation entry. Now, if we take a look at where the price pushed into the new high here, we can see that we have a low formed around this area. So on a smaller trend, we have a low just here. We also have some previous lows in this trend at this level and even down towards some of these other lows at these levels too. If we go to a lower time frame here, such as the 30-minute time frame, we get to see these breaks of structure a bit clearer, okay? We have multiple lows taken out by the bearish move down in price just here. And we also can see around this area here, we have a candle before an impulse to the downside. So I'm going to just pull price back so you can see what I mean here. After retesting this high, the market comes down and breaks structure. And then we create a supply zone inside of this move. Why is this a supply zone? Well, it is the final point of consolidation before this large downward move. So we know that selling has kicked in at this level. We can actually use this then to place an order. We could place a sell here. Your stop loss realistically could go all the way above the high, or you could put it somewhere inside of the range dependent on the price structure. For this, we're going to be safe and put it all the way above the high. And then your target could go down to wherever you're expecting the trend to continue to, okay? Now, because we have efficiency, which essentially means there's no imbalances inside of this range, we could actually bring down the stop loss a little bit, okay? We're going to do that just to amplify the risk reward. And you'd realistically enter your trade on this supply and then look to take the market lower. For this simple example's sake, let's just take it down towards the next low, okay? This is a standard simple target. This is going to be the easiest way for you to trade off of these trendline inducements. So your order would look like this. And then, as you see, the market makes a bearish movement down to retake the low. Now, the reason this happens, if we talk about it one more time, first of all, we have the liquidity inducement at this high, essentially where buyers and sellers are going to be placing lots and lots and lots of orders, which is going to draw the market in. Okay, so when we have lots of sell orders above here and lots of buy orders above here in the forms of stop losses and break retest buys, when the market gets to this region, it's going to be drawn through towards that point. The second point is the real structural high-low format of the market price. We want to look at the real candlesticks, the real price levels, and identify where these highs and lows are. We have high, low, lower high, lower low. So as long as we stay under this lower high, the market is bearish and we should only look to sell. So we do not get trapped on the buy side of looking for break retest opportunities. And then the final pointer is the supply and demand, where we are identifying high probability areas for the market to reverse back to the downside based on looking at areas where significant selling has taken place in the past. These are what we use for our entries, and if we want to play safe, we can use this confirmation-based format to get into trades safely as well. Now, I didn't mention timeframes in this video because this will work on all timeframes, even down to the 1 minute. If you want to trade this on the 4 hour, the daily, the 1 minute, the 10 minute, the 15 minute, it really doesn't matter. And the other thing is as well, I've just flipped the chart upside down to give you an insight into what the bullish version of this trade would look like. It is exactly the same, but we see demand zones, which is basically a